Hello everybody, good day. This is Pipsla FX. Welcome again once more to my YouTube channel. Today we'll be talking about inducement and liquidity in Forex. We've talked about it on our previous class, but for those that didn't meet up, I would like to throw more light on it. This is the basics, contains all about the basics of liquidity and inducement. On our next topic, I'll be telling you how to trade them. So I'll also be drawing the diagram here, so pay attention. This class will be short, so you learn a lot from it. Pay attention and give us a subscription, like, and also share in order to enable us post more videos. So we are talking about inducement and liquidity in Forex. Now, as you can see, the cover page today will be talking about the title, then the subtitle will be the mastering market manipulation for smarter trading. Why it also includes Pipstar FX logo. So let's start from the introduction. Now, understanding inducement and liquidity in Forex. First of all, what is inducement, what is liquidity, and why does it matter? Inducement is a deliberate price movement orchestrated by institutional traders, which are the smart money, to lure retail traders into unfavorable positions. It often involves false breakouts or stop hunts to trigger stop losses or pending orders. Mind you, that is inducement. Inducement and liquidity are somehow synonymous, so you have to differentiate them. Liquidity is the availability of buy and sell orders in the market, enabling smooth trade executions. Liquidity pools are areas with high concentrations of stop losses or pending orders, often targeted by institutions. So liquidity works with after inducement. Liquidity works with after, while inducement works with before. So look at liquidity as the fuel for the market, while look at the inducement as the trap. Inducement is the trap that creates liquidity. And for something to fuel a movement, it has to do with power, to gain power. Now, if inducement is being created, there will be liquidity under it. That is why liquidity serves as fuel. So liquidity comes after inducement in order to fuel the smooth run of the market. So why does it matter? So why it matters is that if you recognize inducement and liquidity, it will help you to avoid traps. It will help you to align with institutional strategies, that is the big traders. It will also improve trade precisions and profitability. So get this right. Now, on the mechanics of inducement and liquidity, from the definition again. Inducement is a price action strategy used by institutional traders to trap retail traders. Common forms include These are the forms of inducement. Like I said, inducement is a trap. These are ways at which they create that trap in order to lure retail traders, in order to gain liquidity from them. Now, inducement is a price action strategy. Yes. Now, with the forms of inducement, we have false breakouts, where price breaches key levels, e.g. support or resistance, triggering retail orders, then reverses. That is a manipulation whereby price gives us a bullish uptrend. We think that okay, maybe because of this breakout candle from a resistance area or a support area, we think that the market is likely going to buy or sell. We end up entering early. Meanwhile, it's going to close with a weak rejection. Then at the end of the day, we lose our trade. That is a false breakout. Now when we talk about stop hunts, that is areas of psychology at which you place your stop losses. The market will always spike to hit those stop losses at predictable levels. So either previous highs or previous lows. Remember, this is where we always put our SL at the protected low or protected high. So these areas can easily get manipulated if you don't know what liquidity is. That is why you have to always wait for manipulation. If price has already been taken out with a weak closure or a shadow closure of that candle, then you can get into the sell. That is, you are trading after the liquidity. After the inducement. You understand? So we have other block inducement, zones mistaken for supply and demand areas. So These are the forms of what? Liquidity. Now, when inducement, when we talk about link to liquidity, institutional traders requires what? Liquidity to execute large orders. They need to fuel the market. So they create inducement to access liquidity pools before what? Driving the market in their intended what? Directions. Now, let me give you a precise diagram of liquidity / inducement strategy. Now let me clean the first diagram. Now remember how to spot liquidity. This is how to spot liquidity. You can write this down. Liquidity, how to spot liquidity. Liquidity is not how to spot, how to spot inducement. I'm telling you about the strategy now full time. How do you spot inducement? Inducement is the first swing high or swing low after a market structure shift or a break of structure. I believe you all know what a market structure shift and a break of structure is. So inducement is the first swing high or swing low after a market structure shift or a change of or a break of structure. Now what am I trying to say? For example, let's say we have something like this, like this, like this. Remember, this area has our what? Market structure shift. True or false? This area has a market structure shift to the upside. Do you understand? This is a market structure shift to the upside. Let's say now the market was, let's say, on a downtrend. Sorry. Let's say the market was on a downtrend, like this, like this, like this. Oh, why is it mistaken? So let's say here, here. You understand? So this is a what? A market structure shift to the upside. Now, the first swing low to this point becomes your what? Inducement. This area becomes your what? Your inducement. Now remember, there should be a breaker block here. There should be a breaker block here. Remember, this is an advanced class. It's an advanced class, so you have to know what a breaker block is, and there should be an order block located at this area. This area, there should be another block located here. Now, if this is the inducement, this area becomes our area of liquidity, the breaker block or the what? Order block. You understand? So how do you spot inducement? Inducement is the first what? Swing low or swing high after a market structure shift. If it is a bearish market structure shift, you should take the first swing high or swing low, depend on whatever happens on the chart. Now, the rule number 2 is that what? The nearest point of interest, the 2 point of interest you have to work with is your what? Breaker block and your what? Order blocks. These are the 2 point of interest you are going to work with. These are the 2 points of interest we are going to work with, your breaker blocks and your order blocks. Now, after knowing all this, you have to trade with the nearest point of interest. You have to trade with the nearest point of interest. Number 4, it must be what? Unmitigated. It must be, those areas, those points of interest must be what? Unmitigated. Now, if we have our inducement at this area, the nearest point of interest should be our breaker block. So we'll be taking our entry from the breaker block area. So we want to see something like this, then push up. So we'll be taking our buys from this point. This point. Now, in a situation whereby we have let's say we have a mitigated breaker block. We have a mitigated breaker block. For something mitigated, that means it has been reacted to. So let's say now we have a mitigated breaker block. That is, the inducement reacted from this area, then pushed to the upside. Our nearest point of interest should be the what? The order block. So we'll be taking our entry from the order block, push up. That is it. Are you with me? So that is it. That is how to trade what? Inducement / liquidity. On our next class, I will be telling you rules of guiding breaker blocks and order blocks. So for now, get this straight. How to, let me see if I can get example on the chart. Let me see if I can get examples on the chart. So this is how to trade what liquidity strategy, or you can call it inducement / liquidity strategy. If you have any question you'd like me to, for the sake of time, I won't be able to show more samples, but if you have any question you want me to share more on it, please kindly put that on the comment section so that I can go through it and then we'll talk about it on our next class. Kindly subscribe to our channel, like and share so as to enable us post more of this video. Give us a like. Thank you for your time. So bye for now.